Most new traders don't lose money because they picked the wrong stock or the wrong coin. They lose because they never learned how to manage risk. In the next 9 minutes, I'm going to show you the exact capital management rules that professional traders use to stay in the game, even after a string of losses. This is the one video every beginner skips, and it's the one that actually saves your account. By the end of this video, you'll understand 4 things: how much of your account to risk per trade, how to size your positions correctly, how to set a stop loss that actually protects you, and the 2 mistakes that blow up more trading accounts than bad analysis ever does. Quick disclaimer: this is educational content, not financial advice. Everything here is about protecting capital, not predicting the market. Let's get into it. Here's something that surprises most beginners. You can be right on your trades more often than not and still lose your entire account. And you can be wrong most of the time and still be profitable. The difference isn't skill at picking direction. It's how much capital you put at risk on each trade and how you cut losses when you're wrong. Capital management is the framework that keeps you in the game long enough for your edge, whatever it is, to actually play out. The foundation of capital management is position sizing, deciding how much of your account you're willing to lose on a single trade if you're wrong. A common professional guideline is to risk no more than 1 to 2% of your total account on any single trade. So if you have a $10,000 account, risking 1% means your maximum loss on that trade, if your stop loss gets hit, is $100. Not $100 in the position size, $100 in actual loss. Here's how that translates into position size. Say you want to buy a stock at $50 and your stop loss is at $48. That's $2 of risk per share. If your max risk is $100, you divide 100 by 2, and that tells you your position size, 50 shares, not more. This single calculation is what stops one bad trade from wiping out weeks of gains. The second rule is risk-reward ratio, how much you stand to gain compared to how much you're risking. If you risk $100 to potentially make $100, that's a 1-to-1 ratio, and honestly, it's not great because you'd need to win more than half your trades just to break even after fees. Most experienced traders look for a risk-reward ratio of at least 1 to 2, or ideally 1 to 3, meaning for every dollar risked, the potential reward is $2 or $3. With a 1 to 3 ratio, you can be wrong 6 times out of 10 and still come out ahead. A stop loss only works if it's placed intelligently. A lot of beginners set their stop loss based on how much money they're comfortable losing, instead of where the trade idea is actually invalidated. That's backwards. Your stop should sit at the price level, where your original reason for entering the trade is no longer true. For example, just below a key support level or below a recent swing low. Then you adjust your position size to match that stop distance using the position sizing math we just covered. This is also where charting tools matter. Personally, I set price alerts and draw my support and resistance levels directly on TradingView before I ever place a trade. It takes the emotion out of deciding where to exit. The fastest way to blow up an account isn't one bad trade. It's stacking too much leverage or putting your entire account into a single position. High leverage magnifies both gains and losses, and a small price move against you can wipe out your margin entirely. A simple guideline: never risk your entire account on one idea, and if you use leverage, understand exactly how much a given price move will cost you before you enter, not after. Let's put all 4 rules together. You have a $5,000 account. You decide to risk 1% per trade. That's $50 max. You find a setup where your entry is at $20, and your stop loss, based on support, is at $19, $1 of risk per share. $50 divided by $1 means your position size is 50 shares. Your target, based on the next resistance level, is at $23. $3 of reward per share against $1 of risk. That's a 1-to-3 risk-reward ratio. If you're wrong, you lose $50, 1% of your account. If you're right, you make $150. That's capital management in action, not predicting the market, just controlling the outcome when you're wrong. 2 habits wreck more accounts than bad analysis ever does. First, revenge trading, jumping straight back into the market after a loss to win it back, usually with a bigger position and no plan. Second, moving your stop loss further away mid-trade because you don't want to accept the loss. Both of these break every rule we just covered. The fix is simple, even if it's not easy. Decide your risk and your exit before you enter, and don't touch either one once you're in the trade. None of these rules work if you can't see your levels clearly or you're calculating position sizes by hand under pressure. This is the exact charting platform I use, TradingView. It lets you draw support and resistance, set price alerts so you're not staring at charts all day, and even has built-in position sizing and risk-reward tools. If you want to try it, I've put my link in the description and pinned comment. Sign up through it, and you'll get $15 off your first plan. It costs you nothing extra, and it's how you support this channel. Let's recap. 1. Risk only 1-2% of your account per trade. 2. Aim for a risk-reward ratio of at least 1-to-2. 3. Place your stop loss where your trade idea is actually invalidated, not just where it feels comfortable. 4. Avoid overleverage and never put your whole account into one position. Master these 4 rules before you worry about finding the perfect entry, because capital management is what keeps you in the game long enough to get good. If this helped, subscribe. I'm covering one trading fundamental like this every week, and remember, the TradingView link with your $15 discount is in the description and pinned comment below. See you in the next one.